I just watched a stock drop over 50% in less than 1 minute on breaking news. And I've got the live trading archive so I can show you what just happened. I think you're going to find this to be very interesting. Now, to give you context, I'm a day trader and I crave volatility. I don't make money buying something at 5 and selling at 5. I make money buying at 5 and selling at 6, 7, or 8. And if I could do that in a 15, 20-minute time frame, that's a fantastic trade. What creates that level of volatility typically is a catalyst such as breaking news. When a company has great news, we've seen prices go up over 100% in a matter of minutes. I've seen stocks go up over 500%, over 1,000% in one day. These are incredible moves to watch, and it's even better if you're in the trade. But breaking news goes both ways. And today we've got an example of a company that put out news that was not so good. It was not well received by the market participants, and the price immediately drops. So let's get dialed in here. Now, what you're looking at is my actual trading screen. And I recognize there's a lot of numbers here. So I'm going to get you focused on what we really need to watch for this live trading archive. This is the stock in question right here. It's in this yellow window. And what we have here is called level 2 or depth of market. This is showing us all of the buyers on the left. These are people that have put out orders to buy the stock, and these are all the prices that they've placed the orders at, and these are the amount of shares that they want to buy. Now, when you see 1, you always add 2 zeros. That's actually 100 shares. So 1,100 right here, 200, 100, 200, 100, 100, 100. Now, on the right side, we have all of the people that have put out orders to sell shares of the stock. These are the prices they want to sell at. This is the number of shares that they're trying to sell. So we've got the buyers on the left. We've got the sellers on the right. This is a small little time and sales window, also known as the tape. And this is a bigger version of the same window. This shows us every actual order that goes through the market. So this is a streaming real-time feed of every trade that goes through, and that's focusing on this stock right here. Now, this is my stock chart. So this is a candlestick chart showing that the price has already gone up. In fact, it's up 76% before this bad news came out. The price had squeezed from $9 up to 10, up to 11, up to 12, up to 13, 14, pulled back, popped back up, pulled back, squeezed up to nearly $16 a share before kind of dipping back down here. Now, I had already made some money on it. I'm up $7,248.77 on the day. I'm up $9,000 just on this stock alone, but I'm not in it right now. The reason I'm not in it right now is because there's not a setup that I like. I was trading it in this area here, and right at about this point, you can see the MACD, Moving Average Convergence Divergence Indicator, has crossed over to the negative. Right there, the blue line crossed below the orange signal line. That crossover for me indicates that the front side of this move is over. Now we're going into a longer period of consolidation. I could be interested in trading it again if it curls back up. And if it does, the MACD will probably curl back into the positive, and then I would consider a trade. So at the moment, I'm not trading it. I'm just sitting tight. All right, so let's watch this live trading archive. The current time is 9:14 and 44 seconds. Now, typically, breaking news comes out at the top and the bottom of the hour. So 7 a.m., 7:30, 8 a.m., 8:30, 9 a.m., but in this case, we get news at 9:15. That's not totally uncommon. We do sometimes see headlines at 8:15, 8:45, 9:15, etc. And that is obviously the case here. So this is a headline that's already been scheduled, essentially. So it's going to get posted right at 9:15. So let's watch what happens as we come up to 9:15. So it's 9:14, 49, 50, 52. These are actual orders that are going through the market. 55, 56, 57, 58, 59. And the second we go to 15, instantaneously, what happens? It's sort of remarkable how fast this happens. And this is the result of high-frequency trading algorithms that are programmed to respond as soon as they see these breaking news headlines. So immediately we're seeing selling. And look at all of this selling right here. You can see these are all of the sell orders that are going through. Those are the prices. These are the shares. This is the time. It's 9:15 and 2 seconds. These are the different routes the orders are going through on. It instantly drops from about 13:30 to 12:60. Now let's just watch this and then we'll go back and replay it. 12:60 on the bid, 12:50, $12 on the bid, 11:50 on the bid, 10:20 on the bid, $9 on the bid. Back to 10 on the bid. 10 on the bid. 940 on the bid. 928. 850. $8. 845. There we go. 795. We're now down nearly 50% off the top. Look at how fast this has dropped. Only 30 seconds after the news. $7 on the bid. So what happened here? Well, what happened was breaking news. Breaking news came out, and in this case, it was not good. So this is a company that is a lower price stock, obviously. Now, the stock has recently squeezed up in the last few days. Now, as we look at the daily chart, this will give you context. You can see that over the last few days, the price has squeezed up a ton, from about $3 a share all the way up to nearly $16 a share. This is a big move, but let's put it into context. So let's scroll back a little bit. What we can see is that a couple months ago, they did a 30-to-1 reverse split. The S on the chart indicates the split. So that means that the price went up by a ratio of 30, and the number of shares available to trade went down by that same ratio of 30. This is a stock split. You can either have a traditional stock split or a reverse stock split. I'll explain a little bit more about how that works in a moment. Let's scroll back. Holy smokes, look at this chart. Okay, so they did another split back here. This was a couple years ago, a 17-to-1 split. And after that, the price actually squeezed up a lot. But eventually, it came all the way back down and made new lows, which is what forced them to do another stock split. We scroll back even further, and whoa, look at this chart. It looks like it had a high of nearly $40,000 a share, but this was never a $40,000 a share company. So this is the typical small cap cycle that we see. So what happens is the company does their initial public offering. They sell shares, and let's just say for the sake of argument, they sell shares at $10 a share and they sell 5 million shares in their IPO. That gives them $50 million, which they can invest in the company. After a few months, the price goes up a bit and then it starts going down, and it goes lower and lower and lower and lower. Now, if it goes under $1 a share, if it goes under that $1 a share mark, they're no longer in compliance with NASDAQ. NASDAQ is going to say, hey, you got to get your stock price above $1 a share, or you're going to get delisted to the over-the-counter market, the OTC market. So they say, well, geez, we don't want to get delisted, and we're not able to get our price up in any other way by being a better company. So what we're going to do is a reverse split. So let's say the price is 50 cents a share. All right, so it's declined all the way to 50 cents a share. They do a 10-to-1 split, and on the next day, the price is $5 a share. But the float has gone down by the same ratio. Now they only have 500,000 shares available as their float. So the market cap is unchanged, but the price has changed and the number of shares available has changed. Very common. Okay, so now you've got a 500,000 share float company priced at $5. They put out some good news. Traders jump on it. Next thing you know, it's at $6, $7, $8, $9, $10, $11. Goes up 100% in a matter of hours. We see that. This is very common. But what happens? Well, a lot of these companies, they're kind of strapped for cash. They're not doing so well. The price of the stock keeps dropping. The company's obviously not producing earnings that support people investing in the company. And a lot of these companies have a shelf registration. This is a S3 filing with the Securities and Exchange Commission. And this gives them the right to sell more shares at any time. Now, a lot of small cap companies have a shelf registration filed. It just gives them the right to sell shares if needed. And a lot of times it is needed. So what ends up happening? Well, what ends up happening is the price squeezes back up from 50 cents. They do the split, and then it goes up to, of course, the reverse split puts it priced at $5. It goes up to, let's say, $10. And then the company announces they're selling more shares. Now, if they sell 5 million shares, just for instance, at $10 a share, they'll raise another 50 million bucks. But let's be real. Who's going to pay $10 a share? It's 100% premium over the price from just a week ago. So most likely, what are people going to pay? $5, maybe a little less, maybe $4. So let's say they do $4 a share. So $4 a share, and let's say they just do 3 million shares. So now they raise 12 million bucks. They'd get 12 million share secondary offering, but it's priced at $4. So not only are they diluting the value of the company by increasing the float from 500 shares to now 3.5 million, 3.5 million, the number of shares available to trade is going up, so value is being diluted. They're also selling them at a discount over the current price. What happens? The stock price drops. And what price does it drop to? Typically, it drops very close to the price of the offering, $4. And so now here we have today. All right, so GTBP puts out news at 9:15 of a $3.2 million offering. So they sold, in this case, let's see, at $4.35. A lot of times they'll sell a combination of shares and warrants. In any case, the total proceeds are expected to be approximately $3.2 million. And as a result, the price drops. Now, having said that, $4.35 was the offering price. The price is still holding at $7, but I don't know how long it's going to hold at that level, because the reality is this is a pretty weak offering. The offering price was 75% lower than the current trading price. If they had done that same offering at, let's just say, $14, it would have been a completely different story, because then what you see is, wow, someone is giving this company, $3 million, $4 million, $5 million at a price of $14 a share. That's an incredible level of confidence. But getting $3 million of stock at $4.35 a share, they could turn around and sell that right now for like a $2-3 million profit, right? And who knows, maybe they would. So this is the problem. When they sell those shares to an institutional investor, which is typically what it is, or they sell those shares directly onto the market, onto retail traders, now you've flooded the market with shares. Basically, they've printed money. And if it's in the case of a placement to an institutional investor, they could dump those shares at any time. If they sell direct onto the market and they're selling to retail traders, well, then those shares have already been put into the market. You're not going to have an instant big sell order. But either way, it's diluted the value of the company. This is not a good thing. So this is an example of bad news coming out. And the fact is, offerings are a part of the small cap cycle. They can happen at pretty much any time. It's important to know that whenever you're trading a stock that's on day 2, day 3, day 4 of continuation, and it's one of these stocks that's been beaten up for a long time, you do have the risk of news coming out of a secondary offering. That's what ended up happening today. Now, I was trading it just a little bit before this news came out. Had I been in a trade and that news came out right at 9 a.m., most likely I would have taken a loss. And that's simply the risk that you take when you're trading. Now, at the same time, this stock went from $8 up to $16, which is a 100% gain in a matter of about 15 minutes. So for me, the way I think about it is that I understand trading small caps is risky, but as an active day trader, I crave volatility. And I'm right more often than I'm wrong. My profits sort of speak for themselves in that regard. So it's true that this can happen, and it's unlucky if you're in a trade the moment that news comes out. And one of the things I do to try to mitigate that risk is I avoid holding for long periods of time while I wait for a pattern to form. I'd rather be on the sidelines in all cash while I wait for the pattern to form. And then once the pattern forms, I get in, I trade it, and then I get right back out. So I try to limit my time in the market. Now, it doesn't mean that I couldn't have the misfortune of getting caught in a drop like that. It's happened before, and it could happen again. It probably will at some point. But in total, as long as I keep myself in the market for limited periods of time, and I stay focused on trading really good quality patterns, and I'm most aggressive in share size on day 1 of the move, I'm going to reduce the likelihood of having a really big loss from something like this. Now, this was a pretty incredible example. It was pretty cool to watch. So let's replay that live trading archive one more time. Okay, so we're coming up here to 9:15. So once again, 9:14, 56, 57, 58, 59. There we go. And look at that drop. Instantaneous. Down to 12. Down to 11.50, down to 10, down to 9.40. Bounces back up to 10. There's some traders that are buying. Maybe they're covering short positions. Maybe they're buying because they think that this is a dip and they don't see the news yet. We break 9. We go down to 8.51, $8. back to 848, back to 809, 810, down a flush. Big sell order goes through 798. Now this ends up it bottoms out around this area. It goes a little lower down to 7, but then it kind of holds this area. And in fact, it does end up giving a little bit of a bounce off these lows, but I'm usually not interested in trying to trade this type of bounce to the long side because that breaking news is bad, and there are going to be people who are just going to continue to sell into that move. And it's probably going to keep unwinding. It's pretty rare when you have that kind of news headline for the stock to curl and come all the way back up. It's very rare. It's not that it's impossible, but it's not what usually happens. Usually these just keep unwinding and they go lower and lower and lower. So if you found this episode interesting, I hope you hit that thumbs up. I hope you're subscribed to the channel, and I'll see you for the next episode real soon. And I'll remind you, as always, that trading is risky and my results are not typical, and there's no guarantee you'll find success whether you trade with me or you learn on your own. So manage your risk, take it slow, and I'll see you back here for the next episode real soon.